You're a global investor. Do you care about the domicile of the headquarters of a company or its primary listing?
You have to care. And you have to care because governance and regulation are a key part of how a company gets valued. So, for example, its tax rate matters. They may be subject to tariffs. And then the third aspect of why it matters, it's operating currency. Where is your revenue, but where is your cost base? And that arbitrage can be very powerful.
Today, I'm joined by Gerald Du Manoir. Gerald is based in London. He's an equity portfolio manager. He's been at Capital Group for 33 years. Welcome, Gerald.
Thank you. It's good to be here.
So no better way to start a conversation than quoting your wife. So Carla would say you are the most grounded, uprooted person she knows. What does that mean?
Well, she knows me extremely well to start with. And what she refers to when she says that is that I tend to stay very calm across many different situations. But most of all, I just can't stay in one place at the same time. So I look like I belong everywhere, yet I belong nowhere. And that's what makes her laugh all the time.
And you've lived in a lot of different places. So how many? Do you have a count?
I don't have a count, but I lived in Tokyo, I lived in London, I lived in Los Angeles, I lived in New York, I lived in Paris, I lived in Geneva. I think I've hit every continent except possibly Australia as a main resident, but a lot of places.
You started off looking at Europe as an analyst, covered a whole bunch of different sectors. Tell us a little bit about the early days as an analyst in Europe.
So the early days were fun because it was a bit of an unknown. We sort of took the world and figured out where it made sense to go follow companies. I started as a building materials and construction analyst, and it at the time was a rather sexy industry, which kind of hard to imagine today. But it had things like plasterboard and cement, insulation, electricity, all sorts of things that were big companies for that period. I quickly discovered, this was in 1992, I quickly discovered that interest rates were a very key part of how these companies' stock valuation were being evaluated. And to a large extent, 92 to 94 was a glorious period. It was a period where Margaret Thatcher had basically done a massive devaluation in the pound. The house builders were flying. Everything was rosy and interest rates were really appealing. And then 94 came. And 94 was, as you recall, a devastation of interest rates. And these stocks gave up everything they had gained pretty close. So the second lesson I learned in the early days was it could be fun, it could be good, but it could also be very short-lived. So it meant that after that, I went to my research director at the time, and these are people who basically manage the coverage of analysts around the organization, and said, can I have something a little more stable? Something that maybe included longer time frames. And I started covering beverages and tobacco and consumer goods, and ultimately gave up the construction and building materials.
A little less interest rate sensitive, perhaps?
A little bit less interest rate sensitive.
So you tend to look at things in a very unique way, and you identify these inflection points through important events. What are you looking for? What are those inflection points and important events? How do you think of that?
Well, I think the early part of my career influenced me a lot in thinking about how we could make money in companies over long periods of time. And it came from the fact that you can focus on the very short term and ask about price earnings and price to cash flows and all sorts of things that are the usual financial 101 metrics that people look at. But in the end, what matters in the change of a company and the change of its valuation is either there is a change in the product, a change in the way that it's run, a change in the external events that may influence it, or simply a lack of recognition of what it really represents. And those are the ones I call the inflection points. We're very lucky at Capital to have a group of analysts who know their industries inside out, as if they were industrial investors. And from my perspective, what I always ask them is, tell me what is so different about this company. Tell me where it is going to change either the way it does business or the way that it sells its products. And that's what I look for.
And so when you say how it's so different, are you trying to think about barriers to entry? Or are you trying to think about where it's going to have its competitive edge? What is the different part of it that makes you most interested? Once they give you that answer, what's the right answer?
I don't think there is any right answer per se. I think there are many answers that exist out there. And that's what makes this job so exciting, because it requires you to adapt to every situation. What is true and common is people buy products and services. So your product or your service has to be appealing to your customer. It has to be done in a cost-efficient way. You have to be able to generate substantial profit when you sell your goods. You have to be thoughtful on how you allocate capital to do so. It sounds very simple, but these three principles essentially allow you to make a lot of money.
Well, and the other thing you looked at, and we've talked about this before, is you have all that and that works, and then you need this runway of growth. So how long is that runway? How long are you looking for?
I've been at Capital over 30 years, as you very kindly referred to earlier. There are companies that we've held throughout that period. That runway can be very, very long. And the other thing that's interesting about that is it can reset itself. So a really good company is a company that's able to adapt to its customer and almost cannibalize itself into its next phase. Some of the consumer good companies are extraordinarily good at that. They're able to identify either new geographies, new products, new demands, new categories. And as they do that, they essentially rejuvenate completely their situation. I'll use an example because I think it's probably the one that is
Sure.
most telling. L'Oreal, which is this very well-known brand today in the cosmetic world, really started as a hair coloring business. It's hard to imagine that's really where the core of the business came from.
It's hard to imagine for me in particular,
Well, I'm gonna
but
leave
yes,
that
but for
outside
most
of
people
it,
as
right?
well.
But it then identified a series of categories that it developed into, including through acquisitions. But for the most part, every time it did something, it essentially added to its runway. And that's really what I mean by the length of the runway. We at Capital tend to ask our analysts to think 4 or 5 years out, which is substantially longer than the norm. But in my case, I probably ask them 10 years out. And 10 years is a long time. And so you need industries that are relatively stable, where the barriers to entry are high, where the technology isn't that fickle. And so it gives you that long-term compounding effect in the stock.
You know, Rob Lovelace was our first guest on this podcast, and his answer on that was Nestle. Mark Casey was a guest. He said Google.
And I think Google is a very good example where if this AI situation becomes an asset to them, they could reinvent themselves completely. So that is essentially the thought around the runway.
So you talk about long term. It's one of our core values at Capital Group. We tend to hold for the long term, but you have this percentage of your portfolio for quote unquote temporary events. So tell us what that means. And as a long term investor, how do you think of a temporary portion of your portfolio?
As you very graciously asked me earlier, I've learned a lot from my mistakes. And so in 94, one thing I learned is an event can happen and it can be short-lived, but it can be extremely violent. And during that event, you need to be humble and thoughtful about looking at industries that you may otherwise not be terribly attracted to. And I leave a bit of space in my portfolio to be able to do that. The temporary events can be macroeconomic, they can be political, they can be industry specific. I'll use an example, which is a few years ago, there was and it came from my coverage as an analyst, there was a pretty substantial desire to increase housing around Europe. And so taxation became a big source of motivation to build new multi-family homes, etc. In that context, there were a series of subsidies that came through in Italy, in Spain, in France, and these were relatively small countries where a small change in the governance of the taxation could have an enormous impact. Those are some of the events that I use to say, working with the analyst, are there companies where maybe that small change is going to have a disproportionate impact?
And so do you fund that through cash? Do you fund it through taking some of your lower conviction holdings and trimming them? How do you fund those short-term ideas?
So one, actually, there are a lot of companies that I hold in my slice of portfolios that generate dividends. And so that's incoming cash flow, if you think of it that way. And most of the time, that allows me to build up cash over time, and that is the cash that I source from. The second thing is my favorite tool of investing is my left hand. And I put on the price chart of a given stock and I say, from here, if I didn't hold this, would I buy a lot more of it? And that's a very sharp and powerful test to the conviction in a given company. If my left hand feels a little bit that it's seen most of the upside, then I will tend to trim and then use that cash to reallocate.
Yeah, one of our guests called that the re-underwriting of the portfolio every day.
That sounds much more sophisticated.
Well, either way, but it's it's an interesting way to think about it. I want to talk more about the markets and ideas, but before we do that, we do this office treasure hunt, and for your office, we did take something, but it required a bigger box. So in this box I have, and I'll describe it for those folks who are listening, it is a very nice old football or soccer ball. It depends on where you are in the world on how you describe it. And it's signed by Pelé, which is really cool, by the way. So it's obviously important to you. Are you a huge football fan? Are you a huge Pelé fan? Do you love Brazil? Why the Pelé signed ball in your office?
It is such a powerful thing that I keep on top of my shelf, and I look at it occasionally for many reasons. Yes, I am a big football fan, soccer fan, however you want to describe it. One, because it's probably the most common sport across the world. And so it's the ultimate denominator that you find among the different nations. And remember, I've lived in different places.
A lot of different places.
So that was a big common aspect of my life. The second thing is that this is a very special person. It's a person that came out of an incredibly poor background. Just for reference, Pelé's family did not have enough money for him to have a football. When you think of who he's become with the football game, to think that he couldn't afford a football, they used to use a sock and put newspapers in the sock, and that was his football. At the age of 15, he became a lead player for Santos, and 16 entered the World Cup. That had never been seen before. Of late, we're seeing more of these cases, but back then in the 50s, that was very unusual. More importantly, in the 60s, 1962 actually, he became the lead player and any stardom you can imagine of someone in the 1962 World Cup. But most of all, he became a leader of really what an athlete can share and participate in the political world around the world. And that really is important. So I keep this really to remind myself of three things. One, you have to listen to everybody all the time. Two, you have to be respectful of everybody all the time, which Pelé was and actually had enormous impact in different regions where he was. And three, you may have very significant differences in cultures around the places that you visit as an investor, as a visitor. But there's always a common denominator. So look for that common denominator. And that's why I keep it on my shelf.
Well, thank you. And were you a football player as a young Gerald somewhere in the world?
No, my family is very much a family of rugby.
Okay.
And although I find the game very entertaining, I don't like to get hit.
Got it. That's good. So let's get back to the markets a bit. And we talked about mistakes. So I'm going to give you two opportunities here, one to share mistakes and then one to share your investment edge. But let's start in the more humble way. And everyone who I ask this question reminds me they have a large suitcase full of mistakes. So pick one or two items out of that suitcase and share with us what happened and how it's influenced you.
I'll share my colleague's view of our own experiences. The first thing is mistakes are much more important in your investor life than successes. They're opportunities for you to learn, and they're opportunities for you to discover what it is that either you should have done differently or you should have thought about in a different way. To a large extent, I was very lucky in the way that I had a very big mistake early in my career. And it also speaks incredibly highly about what capital is about. I was a construction and building materials analyst.
Early 90s.
Early 90s. I thought that infrastructure was going to be an enormous source of economic activity as well as construction activity. As such, there was a very big project that had the foolish idea of linking the UK with the continent. They were building a tunnel under the channel. And I was at the same time quite good with Lotus, which was the predecessor to Excel, in spreadsheets. So what did I do? I did what every mathematician, financial analyst would do, and just build a very fancy model with lots of connecting features and cells, and everything was looking really interesting and impressive. I forgot one fundamental aspect of how things work in life, in the real world, which is that volume is only as good as the price that you can charge for it. And the volume was correct, but the pricing was completely way off, because when you add an unlimited capacity to a given demand, pricing collapses. And so...
And what type of magnitude? What?
I was wrong by about 80%.
Oh, that's some pretty significant pricing
and so
collapse.
Initially, it looked good, and then it stopped looking good. So I learned two lessons out of this, which really marked my career as an investor after. The first one is demand has to have a price, as I just said. And the second thing is recognizing you're wrong is super powerful in a portfolio. And selling in the face of something that was a very hard investment turned out to be the right choice, because ultimately the company went even further down and went bankrupt.
Right.
So why is this important? Because Capital One allowed me to restart and relearn and grow as an investor. And ever since, it really has been something that I keep in my office, as well as a reminder of what not to do. And secondly, it also allowed me to be thoughtful about this long-term aspect of investing. Building a model is not the guarantee that it's going to work. You need to constantly retest it and make sure that your thesis is developing in the way that it should.
Yeah, long-term doesn't mean forever. If the facts
Correct.
change, you have to be able to realize the loss, which is not an easy thing to do.
Correct.
Okay, so we've had you talk about a lot of mistakes. This is going to be the uplifting part, Gerald, where we talk about your investment edge. What is your unique investment edge? Because everyone has one. We're a humble organization, but everybody has one. What would you say yours is?
It's a tough question. I think the first that pops to mind, the impulse reaction to your question, is the curiosity and the desire to find out about everything. I really want to have no preconceived idea of where we're going to be able to make money for our shareholders. It really is an approach of saying, today it may be L'Oreal, as I used as an example before. Tomorrow it may be some new technology, and the day after it may be another infrastructure project. So I think curiosity is really what I'm most focused on still today, honing my skill on. The second thing is I do like to imagine. I like to dream what the company could be. We often talk about earnings per share and price to earnings as a valuation tool to establish the interest in a company. But a long time ago, I learned, with the help of somebody that had been in the organization a very long time, Bill Hurt, that it's even more helpful to think about a company in terms of its size. How big can this company be? And he used to always refer to compounding effect on a company. If a company grows 8% versus 11%, 10 years from now, these are two very different sizes. And that's the tool that I tend to use mostly.
Yeah, people always say you tend to, in those companies that are ultimately very successful, early on you underestimate their capacity long term.
That's exactly right.
And finding those and being curious, it's something when people ask for advice early in the business, I always talk about curiosity. I think you can be curious at 24, 54, and 94 years old. And curiosity is really important. So thank you for sharing that. Long-term trends shaping the market over the next decade. You've got a long runway yourself. We talked about runway of growth. What are these long-term trends that you think are going to be most important for the next 5, 10 years, let's say?
I think the one that I'm still trying to solve for is the complete shift in demographics the world is about to endure. We talk a lot about the aging population in the Western world, but actually the interesting thing is that economic growth has meant that the demographics has changed dramatically in the developing world as well. China has a shrinking population. You're seeing very fast growing demographics in other parts of the world suddenly plateauing and in some cases shrinking. And I'm still trying to figure out what that means in terms of long-term demand for things like consumer goods, and whether we can still use the process of saying world population grows 2.5 and you're going to improve GDP by 2%. And so, you have a base of 4 or 5 a year for these consumer good companies. Is that still true? So I've become probably more circumspect in the categories that I look at. So trends for the next 10 years, if you will, is I think people want to live better. I think whether you come from a low calorie content diet, you're going to move to a different kind of diet, and that different kind of diet is going to have implications on your health, etc. So when I look for those long-term compounders, I really think about the categories in which they evolve. And I that's the first big theme in my portfolio today.
Yeah, it's interesting in the world of demography. I won't get these stats exactly right, but I read something along the lines like in developed Europe, the median age of some of the countries is in the mid 40s. In the US and China, it's identical at 39 years old. And then in India, the median age is actually 29 years old. So people talk about India and China in the same breath, but they're dramatically different in terms of their own demography.
And obviously, they're also entering a period of completely almost opposing economic drive. One will be productivity, so largely automation, and that's what's happening in China. And the other one is basically driving logistics and services through the cheap labor that it has. So that would be the first theme. The second thing that I have in the portfolio is this whole concept of connectivity, the gathering of data. Now, we talk a lot about technology as one big bucket where you're either in favor of tech or you're against tech. I think that's very limited in its analysis. I think data management and data analytics is a very key part of what we're all going to need in the next 10 years. Whichever industry you talk to, they talk about the need to understand A, what they produce, B, who's buying it, and where, etc. And I think that is some of the most powerful value creation we will have is data management and data analytics. So some of the big software companies are still areas where I'm very interested. I have a third theme that I think will impact the next 10 years. And I was reflecting a couple of days ago on the fact that there was a time 2-3 years ago that you had to go to a 7-year maturity to get a positive coupon on a 10-year German bond. That's pretty incredible. Negative. You had a negative coupon. The government was supposed to pay you to carry their bond. A very strange period. So I think what's going to happen for the next 10 years is unlikely to repeat itself. Who knows what the future will hold? But as an investor, I think that has to be an integral part of how I think of the companies that we invest into. That has an impact on the discount rate that you use to evaluate future cash flows, but it also impacts the required return on invested capital that these companies have to generate. So something that generated a 6-7% return on its invested capital may have been attractive when interest rates were minus 70 basis points. Today, not so much. And so suddenly the premium that you need to require on the way the governance of the company is structured, the way that it delivers the reward of invested capital by shareholders is very important. I think Japan is particularly important in that case study. Japan governance is changing and its interest rates is changing. And so the pace of one relative to the other could yield very big opportunities for the next 10 years.
Yeah, I couldn't agree more. I think if you look back to the global financial crisis right through COVID, There'll be so many books written 10, 20, 30 years from now on that dozen-year period of experimental monetary policy. Zero interest rates in the US for a very long time and negative rates outside the US. There was one point you could get a Dutch mortgage for 20 years at zero. So free money, literally and figuratively. And I think that period it was an abnormal period, even though developed markets may have lower rates in the near future as the global economy slows a bit. We're not going back to negative rates anytime in the near future. I want to talk about ideas today in the portfolio. And I'll preface it by saying nothing where you have an open order on the trading desk to buy or sell. But give us one or two ideas in the portfolio and why you like them today.
Sure. Well, they emanate quite a bit from the themes that I've highlighted before. One is particularly interesting because it sort of is a cross section between this inflection point that you were asking about earlier, and at the same time benefits from this very long-term trend of the cloud, digitization, et cetera. And that's SAP. SAP, which was for a very long time this incredibly powerful on-site software system that took a couple of years to embed into your own IT system, today is entirely done through the cloud. At the same time, the company has decided to change the way it operates. And it's much more nimble. It's much more reactive. It is answering a different need by its customers. It used to deliver a fairly standardized but very powerful tool. Now the tool is flexible and more adaptable.
Great. There was something, I know you've been a global investor for a long time. There was people talk about the Magnificent Seven. And then we produced a report that said, well, look at the MSCI ex-US, quote unquote, Magnificent Seven. And it listed companies such as HSBC, UBS, Novo Nordisk, Toyota, ASML, SAP, and Siemens. I think we're the seven. And it said that group of seven in the last couple of years has beaten the US Magnificent Seven by hundreds of basis points of return. It all gets to the question of the company and the headquarter of a company. Do you care about that? You're a global investor. Do you care about the domicile of the headquarters of a company or its primary listing?
I think there are two answers to your question. There is an easy one, which is as a global organization, we really don't care where the company is headquartered. And we don't care because what matters is where the customers and where the revenues are generated. And so we have a see-through process by which we look at where the end market might be. But at the same time, you have to care. And you have to care because governance and regulation are a key part of how a company gets valued. So for example, its tax rate matters, the way that earnings are taxed. It matters because the local regulator may decide that they need to behave in a certain way in a certain market. They may be subject to tariffs, some restrictions. Buying a company in China that's headquartered in China may be treated very differently than buying a company that's headquartered in Switzerland. So if you contrast an automation company in China to one in Japan to one in Switzerland, these are three very different jurisdictions. And then the third aspect of why it matters is its operating currency. And it's not something that we often talk about at Capital, but there are two kinds of currency exposures. One is translational. You basically repatriate the income that you receive, mostly dividends, into US dollars if you're a US dollar investor. But it's also transactional. Transactional is much more important, which is where is your revenue, but where is your cost base?
Right.
And that arbitrage can be very powerful. Japan, with the yen, has just gone from 120 to 160, the relationship between the US dollar to the yen, back to 140. I mean, these are massive moves.
Massive.
And if you have a Japanese yen denominated cost structure versus a US dollar revenue base, that has an enormous impact.
Makes sense. We're going to go towards the end here, and I want to talk about mentors. You mentioned Bill Hurt, who I think was here for more than 50 years. Who else? Who was a mentor at Capital Group that made a difference in your career?
There are so many. It's one of the blessings of working at Capital. My wife often asks me, why do I still work? And I said, well, because I wouldn't do anything else. Every day I get to go work with the smartest people that I get to meet. And it really is an incredible blessing.
And she's happy with that answer, so Carla doesn't have to see you at home every day as well.
Well, there is that. There are a couple of people that were particularly important. There's a gentleman by the name of Don Conlon who was an economist. He really wasn't a portfolio manager, but he influenced research and the way that we did things on an everyday basis. And as part of my training associate program, early days, he was actually one of my mentors in that process. And I actually did a lot of work on the American funds flows and how it evolved according to markets and the difference between concurrent indicators versus future indicators. And that influenced my thought process for many years to come. David Fisher, who for a long time was a trailblazing investor in emerging markets particularly, but also in the non-US world, and was always willing to invest in a growth company as a natural pathway, but also one that would always insist that managements mattered. And that is part of the way I think about it. And someone that actually started your process was Rob Lovelace. And Rob and I have worked together for a very long time. And Rob and I have similar investment approaches. And we were lucky enough, I was lucky enough to be able to, in my early days as a portfolio manager, share my portfolios with him. And we had this banter about where we disagreed. We didn't focus so much on where we agreed, but where we disagreed. And that's very helpful.
And Rob's going to celebrate, I think, his 39th Capital Group anniversary this year. So he's got you by 6. Okay, you can only pick one place. You've lived everywhere. Favorite place to live? No hedging.
No hedging. No, I'm not, none in my mind. But it goes back to the way Carla described me. I'm perfectly happy to be located in one location, and London right now feels fantastic.
Yeah.
But I am totally uprooted. I grow sideways. I don't grow deep. I'm someone who loves to try different places all the time. I'm very curious, as I said before. And to the disagreement of my wife, I could live in multiple locations all the time. So It's no hedging. It really is who I am.
Citizen of the world. We're going to finish up with a moment of gratitude. I'm going to hand you the Capital Ideas mug, and I'd like you to share what you're grateful for.
Thank you. You know, my family life and my professional life have been intertwined because I started here so young, but also because what we do is such a 24/7, 7 days a week job. And what I'm mostly grateful for is that both parties agreed that the Capital Group is such an amazing place to work in and is a family in itself. And at the same time, my family has been so gracious to allow me to spend some time with that other family that I have.
Both families. Yeah, I'm grateful for both families is so important, and I couldn't agree more. I think we're fortunate to be able to work with great colleagues at a company that's so stable and thoughtful, and also have time with our own families. So I appreciate that gratitude. I appreciate you being here. Thanks for joining us, and please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.